Hi there, Shazwin here. So, you want to manage an investment portfolio, but you don't know how. Well, I'll share with you the best portfolio strategies you can use for your personal gains. First off, let me start by sharing some important stuff. What I'm sharing are just guidelines. They are meant to help you in your quest to make an investment portfolio. You're free to choose whichever you want to apply, but make sure you do your own research first to see if it actually fits you. So, shall we begin? So, what is a portfolio? It is basically a collection of investments or financial assets held by an individual, investment company, or financial institution, or even hedge fund. A portfolio's collection of financial assets can include stocks, bonds, art, property, so such anything that can be classified as assets. But the most important thing you need in your portfolio right now is a like on this video. With each like, I'll create more financial videos for you so you can make better financial decisions. It's free and you gain more knowledge when I'm incentivized to make more content for you. So go ahead and hit that like button. Now back to the main point. For a portfolio, diversification is its foundation. So what's diversification? To understand diversification, imagine you have a basket full of eggs. You're carrying them, la 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 la, through the streets, and then suddenly someone bumps into you. You let go of the basket and all the eggs in that basket break. Now imagine you have two baskets instead of one. So instead of putting 100 eggs into one basket, you're putting 50 eggs on your left basket and 50 eggs on your right basket. So when that guy, the same guy that bumped into you before, jerk, bumps into you again, either on the right or on the left, you'll only lose at most 50 eggs. Just one basket. You'll always be holding on to the other basket that he didn't bump into you in. With this, you just managed to save yourself 50 eggs from being broken. That's diversification. In managing a portfolio, you must also consider risk tolerance and time horizon. For risk tolerance, you need to think of it this way. Would you rather keep your eggs in a few baskets so you can easily carry them, or in a lot of baskets? So even if you were to bump into some guy and lose some baskets, you would still have a lot of other baskets that are safe from falling. The answer is your risk tolerance. In terms of time horizon, if it's about to rain and you want to avoid being wet, if your destination, in this case your house, is close, then you will only need to walk home. But if it's far, then you will need to run home. That's your time horizon. So if you're walking home, it's less risky for you to fall and break your eggs. But if you're running home, it will be more risky because there's a higher likelihood of you tripping, falling, and breaking your eggs in the baskets. That's your time horizon. So those are the basics for you to start managing your portfolio. Now, let me share you some strategies. There are 8 strategies that are famous for portfolio allocation. The first one being age-based. How does it work? Basically, it's like this. Take 100 and then subtract it by your age. So for example, you're currently 20 right now. So 100 minus 20 equals to 80. So 80% of your portfolio must be in something a bit risky, like stocks. The younger you are, the more of your portfolio is meant to be in riskier assets because you're young, so you can afford losing some, but we can also afford making lots of money. So it's okay for you to take that risk. But for someone who's 80, so 100 minus 80 equals to 20%, equals to 20. So that's 20% in something risky like stocks or crypto. So someone that old doesn't need something risky. They may need the money anytime soon, so they should do only 20% in stocks. Second, life cycle funds. So this life cycle funds depends on your goals, risk tolerance, and age. This is something that you make out for yourself based on those 3 criteria: goals, age, risk tolerance. There's also a third, constant weight, where you maintain a percentage of assets. So basically, for example, you're investing 20% in Apple, 20% in Facebook, 20% in Microsoft, 20% in Google, Alphabet, 20% in Netflix. Is that all 100%? Okay, just 5 companies, basically just 5 companies. So 100% in all these 5 companies, so 20% in each of these companies, so that's 100% total. Suddenly your Netflix stock goes up by 25%, while your Microsoft stock goes down to 15%. So because your Netflix stock goes up to 25% of your portfolio, while your Microsoft goes down to 15%, you maintain a constant weight. So you sell some of your Netflix stocks to turn it back down to 20%, and you buy some more Microsoft stock to make it become 20% of your portfolio. That's constant weight. Strategic. So strategic portfolio allocations are based on expected returns. So for example, you just heard news that Nvidia is coming out with a new graphics card that could change the gaming industry, and you think that could make Nvidia earn higher returns than and increase their stock price from today. So you buy more Nvidia stock today because you think it's gonna go up in price. That's strategic. And then there's also dynamic. It means you constantly change your mix of assets depending on the markets. So for example, you were investing heavily in utilities, for example, electricity and such, but then suddenly the COVID pandemic happened and you thought, this may be a good time to invest in healthcare because a lot of people are going to hospitals and taking vaccines. So you start going all in on healthcare. So that's dynamic. You're basing your portfolio based on the market conditions. There's also tactical. Tactical is basically a hybrid of strategic and dynamic. And then there's also insured. Insured is basically you're setting a bottom limit for the stocks in your portfolio. So it's for the risk averse people. For example, you have a stock. Right now the stock is worth $100. Then you're setting a bottom limit for that stock at maybe $80 per share. So one day, from $100 per share, it goes down to $80 per share. You sell all of the stock of that company because you already set your bottom limit. You don't want anything lower than that. Even though it may go up, but because you're risk averse, you want to sell it while you can still make profits in it, basically. You're not losing much from it going down. Then finally there's integrated. Integrated is basically a mix of all of these strategies except age-based, constant weight, and dynamic. These are the 8 most common strategies for portfolio allocation that I can share with you for managing your investments. I can't give you a recommendation because each strategy is best suited for different kinds of people, and I don't know what kind of person you are. I only know that you're a fan of my video, considering you've watched it this far, and maybe you're thinking of subscribing. Please subscribe. But we can always discuss it in the comments, so talk to me there if you want. Just consider all the things that I've talked about here in this video and decide on which fits you best, while keeping in mind the risk involved with your decision. That way you won't hesitate when you're doing your investments and you're confident in what you're doing. When it comes to investing, you always need to be confident and careful, maximize profits and minimize losses. In my opinion, out of all these strategies, I think tactical suits me best, but that's just for me. I'm not sure about you. Again, everyone is different. So if you want to talk about it, just do so in the comments. Why I choose tactical is because for my portfolios, I like to remain as passive as possible unless there's an obviously huge opportunity for making profit. So that's when I'll make my move. Unless that happens, I'll focus my efforts on making money elsewhere, maybe through my businesses and such. But again, what works best for me doesn't necessarily work best for you. So after all I've shared, I'm pretty sure you can manage your portfolio yourself, or if you're Malaysian and you still need help, you can just call out to a financial consultant. Like me, just contact me through my socials. I'll be sure to reply as fast as I can. That's my take. Thanks for your time. Oh yeah. Please check out my previous video here. It's good content. It's good. You've watched it this far. You know it's good content. Like and subscribe. Yeah. Thanks.